Most people think that cash is safe. Cash is the least safe investment. It just doesn't have the same volatility to it.
What's up, guys? Ben here, and welcome to Motivation to Invest. Ray Dalio is a billionaire and was the founder of Bridgewater Associates, the world's largest hedge fund.
Those three forces are, first, the long-term debt and monetary cycle, which I mean the creating a lot of debt, monetizing it, and the implications of that, which reverberate through the system in terms of all the markets and everything. The second is this conflict, this polarization, this wealth gap, and how we're at each other's throats. And I looked at the wealth gap, and I looked at a lot of measures of conflict going back in time, and I found that they were in the 1930 to 45 period. The printing of money, as I described, and debt monetization was also in the 1930 to 45 period. And the third big influence is the rise of China, so the rise of a great power, challenging an existing great power, the United States. And that has enormous implications. As an investor, I think what are the relative appeals of the markets, but it has a lot of implications. It's not just a trade war. So the markets and everything were reverberating the trade war, the technology war, the geopolitical war in Taiwan and the South China Seas, and then also the capital war. We're seeing that emerge. So those three factors required me to then go back in history. And I wanted to study the rises and declines of reserve currency empires. So I needed to go back far enough that I would have a few. So I had to go back 500 years so I could see the rise and decline of the Dutch Empire and its reserve currency, the rise and decline of the British Empire and its reserve currency, the rise and beginning of decline for the United States and its reserve currency, and China. And so those are the forces, and that's what I did, which you're referring to. And almost everybody's underweighted China. So if you look by any of the benchmarks relative to world capitalization, and it's also a normal thing because over periods of time, the reserve currency, everybody wants to save in it, the world capital markets, you invest there. So it's underweighted. The first move is to get exposure to China, to get exposure in a diversified portfolio. That means to achieve the right kind of balance of assets in China. Our approach is, we call it an all-weather approach. It's a certain balance in which you achieve balance without lowering the expected return. From that, you want to make the tactical moves. And of course, those change depending on the relative pricing of assets classes and so on. But first, to get the exposure, I believe, right, to those markets and the currency too.
So this was the most analogous to the 1930, 1945 time period. Of course, if we go back in history, we understand what happened. And that sounds really concerning.
Well, it is really concerning. And it's even more concerning when I went back to find the 500 years and the times that repeated over and over again. And what I found was there's a cycle. There's a big cycle. You know, you start a new world order. In 1945, we began a world order after the war. They decided how the world would be divided. They created the dollar as the world's reserve currency and so on. And then because there's so much fighting and then you've established a power that is a dominant power, you have a period of peace and prosperity. And then that gets extrapolated and it leads to more debt. Fear of bad times diminishes. Opportunities of borrowing and getting in debt, particularly if you have a reserve currency, because the world wants to save in that reserve currency. And that gets the country deeper and deeper in debt. And so you have those debt increases and you have bubbles, but you have prosperity. And bubbles are really fun. They're really enjoyable. They're great. But then you get to the point that there is a limitation to that. And those limitations become apparent when the central bank can't easily produce money and credit. That starts when you hit zero interest rates, because then you can't do it the same. Okay, then you go to that's monetary policy one is interest rate monetary policy. When that doesn't work anymore, you go to the next type of monetary policy, which is printing money and buying financial assets. But that financial purchases of financial assets and other things widen the wealth gap, because those who have financial assets do better than those who don't have financial assets, and you have a wider and wider wealth gap. And when you have that wider wealth gap, and then you have another downturn in an economy, that's a formula for a lot of conflict. And so that's what we see. So what does a central bank then do? If it taxes, it takes money out of the economy. That's not good. It's a problem. Mm-hmm. And if it cuts expenses, that's a problem. So the central bank always, through history, this goes back literally thousands of years, the central bank or the entity that controls money then prints more money. Because think of it, we got all those checks in the mail, and we needed to get all those checks in the mail, but you can't take it away from anybody. So where does it come from, and what are the implications? So that happens for logical reasons. And it often happens at the same time as there's a rising power externally as a competitor, which is a challenge in that environment. So yes, it's one of those times. And I think people are not aware of it. Because I learned from my experiences that many things that happened in my lifetime that surprised me never happened in my lifetime before, but they happened many times before and in history. And that if I would go back in history, I could see that. The first time that happened was in 1971. I was clerking on the floor of the New York Stock Exchange, and Richard Nixon gets in front of the camera and says, "We're not going to give you the gold," and devalues the dollar. And I walked on the floor of the stock exchange. I figured there was a big crisis. And I walked on the floor of the stock exchange, and the stock market was up 4%, which was the most in a couple of decades. And I said, wow, that's surprising. And then I found out that Roosevelt did the exact same thing on March 5th, 1933. And what was done in those two times is the same thing that was done on April 9th of this year, when the federal government and the Federal Reserve decided to produce a lot more money and credit. So yes, you need these perspectives, and I want to pass that along, which is why I'm passing along that research on the LinkedIn piece.
Here, Ray, monetary policy, you were just talking about monetary policy 1, monetary policy 2. And, when you think about what's happened, first you had the low interest rates, you couldn't go any lower. So then you had to purchase the financial assets. You mentioned it benefits the wealthier because they own the stocks. So I guess, are we exacerbating wealth inequality here? And
so we're in a new era, of monetary policy 3, as I call it. Monetary policy 3 will mean that the free market will play a much less role in determining those capital market flows, that the government, as we come into the future, will be thinking, how do I get that money to those who need it the most? So it'll be a highly political decision, much more political than it was in the past, and that the central bank then will monetize those political decisions. So monetary policy 3 means there's that type of cooperation. So those are the two dimensions of the big change environment. You're going to see much more government influence and direction of where money goes, which will have a big impact on not only the economy, but of markets. You have to watch what they're going to spend their money on, and they have to watch where they're going to get their money from, what taxes and so on means. The government will play a bigger role. And it also means that there'll be much more debt that is monetized.
And then I guess tying it back to, the investors who are watching, a lot of retail investors, a lot of folks who are my generation as well, how should they be thinking about this? It sounds like, the kind of, I guess, the outperformance that we've seen in the U.S. stock market for so long, they need to kind of think beyond the U.S. Is that what I'm also hearing?
Well, I think first, the most important thing is to realize first, cash is a risky asset. I think so many people think if I go to cash, I'm going to be safe because it's much less volatile. But please realize in this environment of producing a lot more cash, the real returns go down. It's a seductive risky asset because, let's say, relative to inflation, you might get taxed 2% a year. And as you're taxed 2% a year, that's a huge amount of money over time, but it's a subtle tax. So first, watch that. Think about, okay, currency issue or the value of money issue. Then in terms of that, yes, you want to diversify to storeholds of wealth. And the second big thing is diversify well. Diversify well into diversify of asset classes, but diversify of countries, diversify currencies. So think about diversification. If you diversify well, you lower your risk without lowering your expected returns, if you know how to do that well. But I would say, what are the three main things? I don't know. Diversify, 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 I would say. So I would say those would be kind of the main headlines that I'd like to pass. Mm-hmm. If money is hard, when it was connected to gold or it was gold, they always broke that link. And if it was soft, they would always print more money. And you can't raise living standards by printing more money. You can redistribute it. Certainly the money that is being received by those in the form of checks and they go out and spend it helps their living standards. But what it does is it diminishes the value of that cash, and it diminishes the value of bonds because bonds are a promise to receive a lot of currency. And it shifts wealth to financial assets. It always sends stocks higher, like my 1971 lesson. It always sends gold higher. And it also always shifts the impact of currency. So when we're looking at this, we're going to also see, I think, the rise of the increased importance of China's renminbi as a currency. It's got a long way to go before it's going to be a reserve currency. But I think that one of the important things to see is that you're going to see favorable capital flows for China. And if you do a comparison of their markets, where their interest rates are, where their capital markets, who's doing IPOs, nearly half of the IPOs, depending, we'll find out, but something like 45% of the IPOs there will be done in China's markets, Shanghai and Hong Kong this year, new offerings. That'll drive and more you're going to see the internationalization of the renminbi. You're going to see capital flows move in those directions. And those kind of analogous movements have repeated through history.
I hope you guys enjoyed that interview and you found it both informative and intriguing. Let me know in the comments below your thoughts about shapers and how they shape our world. If you enjoyed this video, go ahead and give it a big thumbs up. That really helps out with the YouTube algorithm. And if you want more investing tips and exclusive stock market picks, which I personally am investing into, then you should definitely consider subscribing to this channel and turn that notification bell on. With that being said, I'll see you guys in the next video. Invest safe.